coming week, we will get our latest chance to assess the state of the UK economy through the updated batch of Purchasing Managers Indices, or PMIs. The readings for the manufacturing, construction and services industries will come out on the 1st, 2nd and 3rd of October respectively. Remember, a score above 50 is usually seen as indicative of expansion and future growth. A reading below 50 is seen as a warning of a slowdown or even a recession. Now, here in Britain in August, manufacturing dips to 47.4, the lowest mark since summer 2012. Construction fell for the 4th time in a row to 45, its weakest reading in over 10 years, and services also fell to 50.6. So all in all, it was a pretty weak set of figures, and economists, and no doubt a few politicians, will be hoping for some signs of stabilisation or even improvement. Now, on the other side of the Atlantic, the big economic figure to watch will be the latest monthly non-farm payrolls data. They're due to come out on Friday the 4th of October in the US. Now, the August number of 130,000 new jobs undershot forecasts, and also the 12-month average of 183,000. It also dragged the 3-month moving average to a level way below that of a year ago. Now, of even greater concern, the numbers for June and July were revised down for the 5th straight downward change to the initial estimate. Now, that might not be a great sign, as you tend to see downward revisions leading into economic slowdowns or even recessions, and upward ones when the US economy is going well. You'll see in the next graphic how the trend to revisions was strongly up in 2015 and 2018, down in 2017, and how it's begun to sag now this year. Now, given the importance of these data points and their potential influence on central bank policy and perhaps even government fiscal policy, you may be relieved to hear that the week ahead is scheduled to be fairly quiet on the corporate front. There is just a select number of trading updates, interim or final results and annual general meetings to note, although names to watch could include the following. Bid target Easy Hotel on Monday the 30th of September. Builders merchant Ferguson and snack seller Greggs on Tuesday the 1st of October. Retailer Tops Tiles and Wizz Air on the 2nd. And another retailer, Ted Baker, on Thursday the 3rd of October. But for all of those, for me, the stock most likely to cause a big fuss in the week ahead is supermarket giant Tesco. The FTSE 100 member is set to release its first half results on Wednesday the 2nd of October. Now, as we can see from this graphic here, Tesco shares have, basically done nothing much over the past 12 months, although there's been some degree of volatility. Weak consumer confidence may be one reason for the slide. Concerns over Brexit and what that could mean for tariffs, costs and supply chains could be another. But the real issue, that may be simply competition. The latest monthly UK grocery market survey from consultants Kantar World Panel revealed that Tesco had lost half a percentage point of market share, down to 26.9% in the 12 weeks to the 8th of September on a year-over-year basis. The big gainers, surprise, surprise, were the discounters, Aldi and Lidl. Analysts will therefore be looking for colour on Tesco's strategic plans when it comes to pricing, product range, loyalty schemes, and progress at the No Fuss Jack's stores, where Tesco has made almost no fuss of its own since the initial noise about the project's launch a year ago. Now, when it comes to the numbers, 3 sets of data will really matter. The first is like-for-like sales growth. In the first quarter, Tesco produced its 14th straight 3-month period of like-for-like sales growth. However, the rate of progress at group level subsided to just 0.2% year over year. That was because the UK slowed again to just 0.8% like-for-like growth and Europe weakened, although Asia finally showed some improvement. These regional trends will also be important, especially here in the UK, although some allowance may be made because the base for comparison from last year is very tough, owing to the hot summer and the effects of the FIFA Men's Football World Cup. Then we will come to pre-tax profit. Last year, Tesco recorded a statutory pre-tax income of 1.67 billion for the whole year and an adjusted underlying figure of 1.96 billion. Now, consensus analyst forecast for this year is 2 billion in the year to next February, so the first half will be expected to show some progress. In the first half of last year, by the way, Tesco made a stated pre-tax profit of 564 million and an underlying one of 806 million. Thirdly, and finally, analysts will look to the dividend, where they're expecting 7.94 pence a share for the whole year, up from 5.77p last year. You therefore guess the first half is expected to show a healthy increase as well on the interim payment of a year ago of 1.67p a share. Remember that Tesco's intention is to eventually pay a dividend that's twice covered by earnings per share, and analysts currently reckon it could get there in the year to February 2021, when the distribution is seen reaching around 9 pence per share. Also watch out for comments on the sale of Tesco Bank's mortgage book to Lloyds for £3.7 billion and any final PPI claims related costs at the bank. Finally, investors will look to Chief Executive Dave Lewis for an update on the core strategic goals that he has regularly outlined since October 2016. Remember that before the Booker deal, Mr. Lewis was targeting a 3.5% to 4% operating margin for this year, 2019-20, up from 2.3% back then. When the Booker deal was announced in January 2017, Tesco then targeted £200 million of cost benefits on an annual run rate within 3 years and a further 25 million revenue synergies. Thank you for watching, and I look forward to seeing you next time.